Warren Buffett, the Oracle of Omaha himself, has sounded the alarm on an impending disaster in the real estate sector. And trust me, it's not just a mild drizzle we're talking about, it's a full-blown $1.4 trillion debt-fueled tsunami that's already crashing onto the shores of the US market. The aftershocks? They're going to be felt in just a few short months. Want to know what's really going on and how it could affect you? Stick around because I'm breaking it all down for you. Let's dive into the heart of the matter with a recent question from Tom Seymour to Buffett.
Charlie Munger has warned of a brewing storm in the U.S. commercial property market, with American banks full of what he said were bad loans as property prices fall. Please elaborate on what's going on in commercial real estate. How bad will the losses be, and what sectors or geographies look particularly bad? I'll just add an addendum from another viewer who wrote in and wanted to know if Berkshire would be more active in commercial real estate as a result.
Buffett's response was a masterclass in understanding market dynamics. He explained that Berkshire hasn't been very active in commercial real estate because it's more beneficial for taxable investors than for corporations like Berkshire. But here's the kicker. He expressed deep concerns about the hollowing out of downtown areas in the US and globally. While he believes the country will weather the storm, he warns that many property owners won't. The buildings will remain, but ownership will change hands dramatically. As we dive deeper into this unfolding crisis, consider this. The ripple effects of this real estate storm won't just stop at property values. They'll extend to local economies, impacting everything from your favorite neighborhood coffee shop to the small businesses that form the backbone of our communities. When small banks, which are the lifeline for these businesses, start to struggle under the weight of bad loans, it creates a domino effect. These businesses might find it harder to get loans, stalling their growth, and potentially leading to layoffs and closures. The dreams of individuals and the vibrancy of communities hang in the balance, showcasing the far-reaching consequences of this crisis. Adding to the complexity is the evolving nature of the commercial real estate market itself. With the rise of remote work, many companies are reevaluating their need for office space, leading to a significant drop in demand for commercial properties. This shift has created a perfect storm where high debt levels meet declining property values and occupancy rates. It's not just about numbers on a balance sheet, it's about the transformation of how we live and work. Urban centers that once buzzed with activity are now facing potential vacancies and economic downturns, reshaping the landscape of cities across the nation. Another aspect to watch is the potential impact on housing markets. If commercial real estate takes a hit, there could be a spillover effect into residential markets. For instance, if small banks tighten their lending standards across the board, it could become harder for individuals to secure mortgages, especially first-time homebuyers. This tightening could lead to a slowdown in housing market activity, affecting everything from home prices to construction and related industries. The interconnected nature of real estate means that turbulence in one sector can ripple out in unexpected ways, affecting broader economic stability and individual financial well-being. Here's why. Over the past 15 years, the US real estate market has been on a wild ride, fueled by massive amounts of cheap debt. Just take a look at the US federal funds effective rate chart. Interest rates were near zero for most of that time. These rock-bottom rates encouraged people to take on huge debts, pushing real estate values to dizzying heights. Imagine someone buying an office building in your hometown for $1 million. The buyer probably doesn't have that much cash lying around, so they go to a bank for a loan to cover most of the purchase. Let's say our buyer puts down $350,000 equity and borrows $650,000 from a bank. The loan's profitability depends heavily on the interest rate. In this case, let's assume a 5% interest-only loan. Each year, the buyer owes the bank 5% of the loan amount in interest payments, $32,500 annually. Whether the property can support this debt payment depends on its net operating income, NOI, the rent minus expenses. Suppose the building generates $60,000 annually. With an annual debt payment of $32,500, this property comfortably covers the debt. Banks evaluate loans using the debt service coverage ratio, DSCR, which is NOI divided by the annual debt payment. Here it's 1.85 times, well above the preferred 1.2 times. Low interest rates made this purchase profitable, even with significant debt. But what happens when interest rates rise? For homeowners, a 30-year fixed-rate mortgage means stable payments. Not so for commercial property buyers. Their loans reset every 3 to 5 years to current rates, which can be devastating. Let's revisit our example. If the interest rate jumps to 7%, the annual debt payment rises to $45,500. If it climbs to 9%, it skyrockets to $58,500, nearly matching the $60,000 income. With office demand dropping due to remote work, suppose the income falls to $40,000. Now the property can't cover the debt, leading to likely foreclosure. The bank takes over and sells it for less than the original purchase price, eating the loss. As Buffett said, the buildings stay, but the owners change. Buffett elaborated on the mess in real estate.
Most people like to buy with non-recourse in real estate. And one time I asked Charlie, there was some real estate guy we were talking to him, how do they decide how much a building like this is worth? And the answer is, it's whatever they can borrow without signing their name. The attitude of most people become big in the real estate business. And it does mean then that the lenders are the ones that get the property. And of course, they don't want the property usually. So the real estate operator counts on negotiating with them. And the banks tend to extend and pretend. But it all has consequences. And, well, we are starting to see the consequences of people who could borrow at 2.5% and find out it doesn't work at current rates, and they hand it back to somebody that gave them all the money they needed to build it.
When you buy a home, you sign a personal guarantee, meaning you're responsible for the loan, even if the property's value drops. Commercial real estate often uses non-recourse debt, meaning the owner can walk away if the property's value falls below the loan amount. With $1.4 trillion in loans coming due in the next 12 to 24 months, many properties are worth far less than their purchase price or can't sustain higher debt payments, leading to potential foreclosures. We're already seeing this unfold. Starwood, a major real estate investment firm, recently defaulted on a $212 million loan for an Atlanta office building. Once 90% full, it's now only 60% occupied. Starwood didn't even try to save it, just handed the lender the keys. This is just the beginning. Small regional and community banks, not large Wall Street banks, make most commercial real estate loans. These small banks will bear the brunt of the storm. While they will face losses, most will survive, with depositors covered by FDIC insurance. However, the fallout will affect small and medium-sized businesses, which rely on these banks for loans. Reduced lending will hinder business growth, hiring, and spending, ultimately impacting economic growth. Only time will tell how this will all play out, but as Charlie Munger noted, there's going to be a lot of pain. The big question is, who will ultimately bear it? Thanks for watching this video. We appreciate your time. If you found it helpful or learned something new, don't forget to like, subscribe, and share it with your friends. Let's keep the conversation going in the comments below. What do you think about Buffett's warning? Stay safe and see you next time.